Welcome to the weekly AFI financial update with financial advisor Brian Walker, president of the AFI Group, and senior investment manager Edward Schuh with Inception Financial Services. Today is Friday, April 9th. I'm your host, Robert Souza. Today we're going to be talking about how to weather the storm. That's the subject of today's Q&A. This has been a tough week for the American people. 1 in 10 of us are now out of work. And every 10 seconds, around 100 of us lose our jobs. We know that anxieties are high. Government checks begin arriving this week, but will it be enough? Small business loans, will that be enough either? May 1st is a long way away. We have some serious concerns about how much longer this country can stay this way. But we have to stay in place. We have to stay safe and look for a light at the end of the tunnel. The task force sees positive signs ahead. There is good news out there. You just have to look for it. The virus is slowing down in Europe. Hospital admissions are on their way down in New York. And every American who's needed a ventilator has gotten a ventilator. The governor of New York, Andrew Cuomo, said that he had plenty of masks and plenty of beds. And the stock market had its best week in over 50 years. So where does that leave the average American? Let's invite guests Brian Walker and Edward Schuh in to help us better understand how we can make the most of the current situation. Guys?
Hey,
Hi,
Robert.
Brian.
How are you?
Welcome. Edward, welcome.
Brian, Robert, thank you. Brian, good to see you too.
And so, Brian, let's go to you and give us an idea how this is affecting you, your personal life, and your business.
Sure. I think we're all in this together. If you have kids, you're at home, your kids are at home, you're trying to get through, all of those challenges with work. Obviously, we're having challenges of not meeting with clients and dealing with the market and, different challenges. But on a side note, I also own a salon and spa where we provide hair services, skincare services, nail services, all services that are basically impossible to keep 6 feet of social distancing. So we're obviously shut down, which has been very difficult, devastating for a lot of the people that are earning a livelihood in that business. And so it's been interesting trying to navigate through this with so much uncertainty. And I'm sure a lot of our clients and friends and family are feeling the same way, the uncertainty of, well, when do we get back on our feet? When do we get back to work and start providing for our family? And so those are the same thoughts that I'm feeling with the business. And if we really look at this, we are at war. I think we've heard that a lot on the news, that we're at war with the virus. And right now, what I see personally is we have the virus versus our economy. And right now, I would say our economy is losing because we've had 6.6 million unemployment claims. And how many businesses are going to have to shut down because of this? So without sounding insensitive, we have a lot of casualties in the economy. And we also have a lot of casualties in the people's personal lives. We have 20,000 people that have died in America from the coronavirus. And so, again, like any war, there's casualties. So at some point, we have to figure out, okay, when is enough enough? And when are we going to reopen? When are we going to allow these individuals to continue providing for their family? And I'm sure for all of you, it's very difficult to plan and make those decisions with the uncertainties. And so, if all of us had a date, hey, if May 1st was the date, let's go, let's get this back together. Well, we can plan for that. And it's just like in your retirement portfolio, in your investment portfolio, there's risk that you plan for. And if you can make those calculated decisions, then you can keep moving forward. But it's very hard right now when we can't make calculated decisions because we don't have enough information at our fingertips to do that. So
You know, Brian,
that's
it's
how
one of
I've
the
been affected.
yeah,
Yeah.
no, one of the ways we hear it termed and referred to as is which is worse, the virus or the cure, the steps we're having to take to actually mitigate the virus, right? And that's the
Yeah.
casualties within the economy, you know. So it's trying to weigh which is going to be worse and more detrimental.
Yeah.
So
And I'd add to that too. I can only imagine that the economic impact will in fact cause health and death impacts long term. We know that the people who are most susceptible are the lower income neighborhoods who don't have as much access to health care, the money to eat healthy and to stay healthy. So as we create so many more unemployed, isn't that also going to create more deaths?
I mean, it very well could be.
choice.
Yeah, especially if you take in consideration the mental health, the psychology behind it, depression, all of those are definitely factors that could have a long-term effect on all of us.
Yeah, and Edward, how's the shutdown affected you and your clients more specifically?
So, I mean, it kind of going through the same thing as everyone else, but obviously having the exposure to the investments and the capital markets and all of those strategies, it's definitely been interesting. You get a lot of calls regarding, where are we at? How are we performing? And so one of the things that I've been getting lately, as you mentioned it earlier, Robert, that last week was one of the best weeks in the market in, 50 years or so. And so now people are looking and saying, well, shoot, has the storm passed? Have we weathered the storm and now, we're going to be headed in the right direction? And unfortunately, I think it's a little too premature to make that call. And one of the things that I wanted to talk about a little bit as far as the markets and the investments is going to be volatility. Right now, what is volatility? Volatility, I use the index VIX, which represents the 30-day implied volatility of the S&P 500. Now, what does that all really mean? Just to kind of boil it down to kind of like a 20 or 30,000 foot view is volatility is going to refer to the degree or the amount of change, how far the market is up or down with respect to how fast it gets there, right? So you can imagine in times of high volatility, like we've seen over the last month and a half, the market may be up 7 or 8% in one day, down 5, 6, 7, 8, 9% in another day. So when we see those rapid swings, we call those high degrees of volatility. So what happened is you can see over the course in that little chart, it stays fairly low until we hit this massive mountain on that chart. And what happened was we had a huge spike in February and March within volatility. So what happens is that means the market is making drastic moves in the positive and negative direction. And what happened is it did come down somewhat over the last couple of weeks in April. But does that mean that now is the time that we can throw caution to the wind? And I think it's a time for us to continue to be cautious. But why are people saying that or asking the question, is now the time to transition into stocks? If you go ahead and show the next slide there, Robert, basically 70% of the time, the S&P 500 is inversely correlated to volatility. Now, what does that mean? It basically just means that If volatility goes up, then the market will generally be headed in a downward direction. Now, it's not all of the time, but if you see that graph just over the course of the last couple of months, where one represents volatility and the red represents the S&P index, it looks like they're almost moving in opposite directions. So a lot of people are thinking, well, is now the time? But what I want to do is I want to show us what volatility looks like compared to the last 30 years of our volatility index. So if you go ahead and show that final slide there, Robert, even though it has come down somewhat from the highs in March, we're still within the 95th to 100th percentile, over the 99th percent. So that means that even though it's less volatile than it was, we're not out of the woods yet. We're still at such high levels that we don't know how quickly the market is going to move. So this is something that I track and monitor on an ongoing basis as well. So now is the time for caution still, but also we want to ensure that we maintain the discipline within the strategy that we have.
And just so I understand, so this is a chart of the percentage of volatility, correct?
That's correct. So
Okay.
this goes back to the beginning of the year when we were around that 15 to 20, which is going to be fairly average. And then where you see the red line where it spikes up, that was in mid-March where we got up into over the 90th percentile, which is some of the highest volatility we've experienced over the last 30 years.
Do you have any indication on when you think the levels of volatility may come back down to where we see what 50, 60% volatility?
It'll be, I think time will definitely tell, and I don't want that to sound like it's a cop out for an answer, but everything that we know is that we don't know the extent of the impact, right? I mean, we're talking about historical levels of unemployment that ideally will be just short term, but it's when will we be able to return to some level of normalcy, and will these stocks, will these companies still be able to generate the types of profit that they did prior to the virus? So there's a lot of unknowns, but these are the types of things that we want to monitor to try to kind of figure out where we're headed, not just as an economy, but with our market-based investments.
Fantastic. I appreciate it, Ed. Now I'm going to go to Brian. Brian, you had mentioned an analogy the other day that made a lot of sense, especially for someone who's not in the financial world. Can you share some actionable steps that our clients can take away to try and mitigate some loss? How do we get back in the market? Because people are looking for answers and solutions.
Sure. As you can tell in the background here, I'm a little bit of a sports fan. So I'm going to use a little sports analogy here of baseball. In fact, I manage my son's baseball team, which of course is.
How did I know the analogy was going to be baseball with you coaching your son's team?
Yeah, right. So my job as a manager is to teach these kids these valuable lessons, right? So let's take a look at baseball, right? When you get up to the plate, doesn't everybody want to hit a home run? I mean, isn't that the goal? Don't we all want to be like Mike Trout, going up to bat and hitting the long ball? So, but unfortunately, we don't always get those home runs, right? So
we also don't want to strike out, do we, Brian?
No, we definitely don't want to strike out. But remember, the top paid baseball athletes get out 7 out of 10 times. Yep. Think about that, right? 7 out of 10 times they're unsuccessful and they still get paid millions. So what I want to instill in you is that, hey, we're not always going to get home runs, right? But let's make sure that when we put the ball in play, that we have a plan, right? And so every good investment strategy starts with a plan. And so we hit that ball, we put the ball in play, and what do we have to do? In order to score, we have to touch 4 bases. So our first base is first base. And so in order to get to first base, we have to stay the course, right? We have to say, look, we put a plan together, okay? We put a plan that hopefully will weather some of these storms, and we're not going to move to cash out of emotion, okay? So we're going to stay the course. We're going to go to first base. And then we round first base, we go to second, all right? Now, this is the big pivotal point, right? Because at this point, you're almost halfway to home. So what do we want to do?
Scoring position.
Yeah, exactly. So at this point, we want to reevaluate what is our strategy, and our strategy is to make it to home, right? So we want to reevaluate our current investment strategy, where we're positioned, how are those positions going to look long term, okay? Well, now we decided, hey, we're going to third base, all right? Well, third base is now we're getting even closer to scoring. So what do we want to do at this point? Well, those of you that have 401ks or retirement plans, we want to keep investing. You want to keep putting the money in. You want to keep kicking hard to try and make it to home, okay? You don't want to let up now. This is not the time to take your foot off the gas. You got 90 feet, okay, to get to home plate. So,
Brian, this actually, the whole concept of, sorry for the interruption. I mean, I know you're getting ready to head, I know you're getting ready to score, but.
Man, I was in the zone, ready to score.
So I just brought up a good point about the continuing to contribute to a 401k. And I think I may have talked about it either in, previous webinars or even previous Q&As, but it's that concept of DCA, or dollar cost averaging, right? Is if we stop contributing now as the market goes down, well, now we lose out on the potential for additional investments in recovery, for buying at a discount. Yeah. So by basically putting in systematically, right, as the market increases, we buy less, and then when the market goes down, we just continue putting in, and now we're buying more. So the average allows us to recover substantially faster. Now, hopefully everybody understood that concept that I talked about with dollar cost averaging.
Well, Eddie, if you made it this far to third base, hopefully you're still putting in the effort, right? And so we need to just keep putting in the effort no matter what. And now if you got those 3 bases out of the way, or those 3 steps, our final base is home. And so if you were able to do all of those 3 steps and make it to home, well, number 4 is, hey, you may have a lot of liquid cash lying around, but you need to be careful, right? Because of what you just talked about, Eddie, with volatility, we are not out of the woods, okay? So if you start taking that liquid cash and start purchasing stocks and various investments because you think you want to take advantage of this uptick in the market, this recovery in the market, well, you might be in for a unpleasant surprise if we still have more volatility in the market and we see some downswings. So it's always important to have some liquid cash around for emergencies. So don't get overconfident just because you're making that home stretch and start putting too much of your liquid cash into these investments.
So, I mean, to talk about myself, I also practice the concept of dollar cost averaging. So, going through this entire process, I did have some money, in savings that was out of the market. And what did I do? I haven't put all of that in. I'm systematically putting it in to the strategy that I know that I have for myself. And so it's not something I don't want, it's not something that we just preach, it's something that we practice as well.
Definitely.
And I appreciate it. And I wanted to just really quickly see if I got this right, Brian, to summarize the 4 points or the 4 bases. And forgive me, there is family in the background because we are all isolating. So if you hear some screaming and yelling going on in the background, that's because we're all staying in place.
Should we bring them into the conversation?
I think they're also on a Zoom call screaming back and forth between multiple people. So we'll let them do that. Hopefully you guys can still hear. But just to reiterate, Brian, your 4 points, because it was really helpful for me, because it made me feel like I had a more complete approach, not just lots of independent ideas. But you really taught me, one, don't panic and pull your money into cash, because it won't keep up with inflation. 2, second pace. 2, wait a second, I think I got it.
Reevaluate
Your financial strategy. And if you haven't sat down with your advisor or you want a second opinion, I would encourage you, Brian and Eddie offer free consultations. Feel free to reach out, get an opinion, and you can get an opinion about your existing plan, and they are more than willing to help you with some advice. So reevaluate your plan. Third base was to keep contributing, which allows you to participate in the recovery. And 4, be careful about swinging for the fences. If you have some cash sitting on the side, make sure you maintain some liquidity and wait for market volatility to settle down before you make really big moves. Does that sound about right?
Yep, that's it. You hit the nail on the head.
What I would say is, if you didn't understand anything about what I said about dollar cost averaging, just keep gradually contributing.
No, it's good. It's a good point. And a lot of people, the natural instinct is to want to stop contributing because you need money. And I don't know if you had mentioned it before, but I know you had mentioned it to me, that you'd rather see someone take a 401k loan than take a withdrawal or stop contributing because of the new laws that are in place now with the stimulus package.
Correct. And especially with like a 401k loan, any interest you're paying back to yourself. So,
right. And didn't they double the amount?
They did. Again, for the 401ks, you're going to want to talk to your employer, because what they've upped the loan amount from 50,000 to 100,000. But at any given time, it'll just be no more than 50% of whatever your total balance is. So so you want to get with your employer and find out how much of a loan you potentially qualify for, or if worst case scenario, if they're going to allow you to take a distribution without the 10% penalty. So
fantastic. All right, well, thank you guys. Any final thoughts before we wrap up?
Well, everybody have a great Easter weekend.
Yeah, happy Easter. Stay safe, stay healthy, keep on the course.
And we will see you next week. If there is anything that you need help or advice on, feel free to reach out to us in any of those fashions that we have there, and we will see you all next week. Happy Easter.